Joining me here, Post 9, Avery Sheffield, VantageRock co-founder and CIO. It's good to see you again. Welcome back.
Great to see you.
What is the significant turning point?
Yes, well, I think it's the combination of the market's reaction to the CPI and Powell's press conference, and of course the Fed decision. So what was really interesting is in both cases, the market was really trying to rally, right after the CPI print rockets up, and then fades throughout the day. Like, that's a very different reaction than we saw in November, where there was massive follow through for multiple days. Then during Powell's press conference, it was fascinating to see that every time he said something that could possibly be interpreted as dovish, even if it's potentially discussing changing the interest rate target in 2025, the market starts to rally, but it just couldn't hold. And so I think kind of more from a technical, from a market sentiment standpoint, that those are very important inflection points that suggest more downside risk ahead.
What degree of downside, right? If you can't,
yes.
you're trying to get something going, you get a good report, as you said, can't rally, give it all back. Well, you could rally, but you gave it all back.
Yes.
And now you continue to get this hawkish Fed speak, and yet the bond market doesn't really want to listen to it.
Right. It doesn't want to listen to it. And I think the reason it doesn't want to listen to it is because fundamentals are weakening. And Powell acknowledged that, right? Everyone's seen that. But that's really not reflected in the valuations of many companies out there. There are certain areas, especially in cyclicals, like as John was saying, potentially in areas like REITs, where in home builders, where we're already reflecting really tough times ahead. But there are a lot of areas of the market where their multiples are still very high, but fundamentals are weakening, and that's why we think that that's where we think that there's much more risk to the downside.
Where are the multiples still the highest, where you feel like there's the most risk?
Yes. So look, as like Chris Senyek and others were saying earlier today, healthcare staples like utilities, those are more expensive, but I don't know that that's where the greatest risk is. I think those would probably be maybe underperformers or kind of more middling. But really, where I think you still see very high multiples and a lot of risk is more in the growthy areas, companies that are trading at very high multiples with high growth expectations ahead.
Yeah, I mean, technology stocks,
absolutely,
which seem, the eye of the storm, epicenter, whatever you want to call it, seem to have the most risk to what the Fed is talking about.
Absolutely. I mean, we talk about it as underappreciated cyclicality, right? Because many tech stocks have had such a long run of success and done so well through COVID. People think that that's likely to continue ahead. But, we're much more cautious because we are seeing signs in many tech companies that they are more cyclical than anticipated because they've gotten to a level of scale where the cyclical dynamics are really coming into play.
Where are there areas of the market where you do think there's opportunity that you'd be willing to now? I mean, it's so hard, I think, for people to get their arms around the idea of, because you sound, obviously bigger picture negative.
Yes.
Right? But that there are areas that you would actually buy stocks within?
Yes. I mean, that's where I think there's a lot of downside priced in. So it's less expensive areas of the market where there's a lot of negativity because maybe these companies have struggled even before COVID. And so people think, oh, if you have a cyclical downturn and the companies struggled before COVID, things are going to be even worse. So areas of such as retail that we've discussed before, that's one area where you have a lot of pessimism priced in. You have multiples, mid-single digits, low double digits, mid-single digits for companies that people think are going away that we don't think are going away, low double digits for high quality companies that we think are much more like staples that people think are going to have very cyclical, significant cyclical pressure.